Welcome, everybody, to today's VA Home Loan Flexibility webinar. It's going to help you on understanding the dialogue and also the things that are misunderstood for VA loans. Will become a much, I think, stronger VA will become a much stronger advocate for you when it comes to talking to other agents. There's no credit for this. It's just learning and information. So now let's begin. Let's meet Jim Perkins, a seasoned mortgage banking professional with over 30 years of experience in the lending profession and is currently with New American Funding. Jim isn't just highly experienced and respected in real estate financing. He's also an exceptional trainer, unraveling the intricacies and complexities of real estate loans and credit in a manner in which you can understand. Because these things, we're obviously not doing loans, and he is. His training ability empowers clients to navigate the mortgage process confidently, ensuring they secure the best fit mortgage for their needs. Jim is a valued member with us, and agents, consumers consistently rate him very highly. And one thing Jim is super good at that I have to say, because most people are not, most are order takers. He's super good and patient at getting people credit ready. So don't throw away people with credit that isn't great, that needs to be worked on, because Jim will work on them and not drop the ball like most lenders I found did. So with no further ado, welcome, Jim.
Thank you, Cindy, and welcome, Terrence and Linda, to today's class. Welcome this afternoon. Before we get started, I did want to ask the people, Terrence and Linda, that are on the class, if that, as you're going through, I guess, your day-to-day activities and looking through the real estate, working on the real estate, if you come up with ideas that you think would be a good class, go ahead and email that to Cindy. Cindy is super good at getting instructors that will explain or putting a class together. And sometimes you can put a class together that you'll get credit for, but putting a class together that will address certain issues or concerns that you think would benefit a lot of people. So Cindy is, she's an advocate for agents out there and trying to develop the school more in a direction to help agents generate more business. That's what we're all about here. So if you come up with those ideas, feel free to just shoot them to Cindy. And we've done that with several classes, put classes together around that. And a couple of them have actually even come up with CE credit. So let's move on then. So we're going to talk about the VA home loan program and how good the home loan program is. But before we get started, this is just a little information on me, Jim Perkins, the instructor for today's class. And I've been doing this a long time and working with NAF. We call them NAF, it's New American Funding, but they can provide loans in all 50 states. And I can help you out with that. Also, too, as we go through the class, feel free to use me as I would say as a backboard or a sounding board. If through your real estate, if you have any things that come up you're not sure about, you need a second opinion, or just want to chat about something that you think might help you as far as real estate is concerned. I've been doing it a long time, so I'd be more than glad to help, especially people that are involved with the Cindy Bishop School. Okay, so our goals today under this program, we want to understand the importance of VA financing in today's market. We're going to dig into how we can help more people purchase homes using the VA loans, and do that by explaining some of the important aspects of the VA loan and how it can help people move forward. Understanding the benefits of the VA home loans and common objections. You'll hear a lot of times that listing agents will come up with, I don't want to take a VA loan. So we're going to dig into some of those objections and how you can overcome those objections. And then some solutions on one of the objections is VA appraisal. So we're going to talk about the VA appraisals, some of the challenges, and then the new legislation that has been to address those challenges that a lot of people are not aware of. Okay, so the VA home loan guarantee. So the one thing I did want to point out is why the VA loan is so important, especially in the DC MSA area, but actually all across the country. But there's just in our area here, there is a number of military bases. And so what you're looking at, if you think about it, you have the Pentagon here, you have Bolling Air Force Base, you have the Marine Corps base in Quantico, you have the Marine headquarters or the barracks in DC, you have Andrews Air Force Base, Fort Detrick, Fort Belvoir, Fort McNair, and that's just in the general vicinity. You have a lot of other bases as you go further south, maybe a little bit west. So it's once you get into it, though, if you're helping somebody that is, especially if they're active military or even if they're a veteran, they keep a lot of close ties. And so I've done loans for somebody that might have been in a squad or a platoon. Now, a squad is kind of the smallest, I guess, smallest group of people. It's usually 6 to 10 people. But as you go up to a platoon, it's 20 to 25. A company gives you 60 to 200 people, and then a battalion is like 300 to 1,000. So as you're helping people, especially like say active people, I've done it where I've gotten into, I believe they were in like a platoon, and then I've helped a person out. And what they've done is they recommended me and the agent we were working with to members in their platoons. And so that recommendation gives you a lot of credibility, especially when you're looking out for the veteran or the active military person and making things run smoothly. So that's really why, I mean, it's so important in this area. And we want to make sure that you're aware of all the aspects of it that can help you generate more loans. The other thing we want to do with this program as we're moving forward is maybe start to get you thinking about ideas. Hey, how could I use this? Or maybe just get the wheels turning for other aspects of financing that might help you generate more business. So the VA, there's been some changes with the VA just in the last couple of years. The VA always used to have a maximum loan amount. And what the new legislation did, some of the new legislation in the last several years, is it changed the maximum loan amount as far as the VA was concerned. So right now, if a person does not have or has not used their eligibility, and that doesn't mean that a person couldn't have used the VA loan before. So they still could have used their VA and still have maximum eligibility. They just have to get the eligibility reinstated. So if they have full eligibility right now, there's really no limit on the amount of financing they can get with zero money down. Now, a lot of companies will limit it to right around 2 million. We've done higher than that on a case-by-case basis. And the reason why you have those restrictions coming out is sometimes the lending institutions are concerned about the I guess liability that they might incur if something happened with that loan. Because remember, the VA eligible person is putting zero money down. So if you're thinking, 2.5 million with zero money down, one, it's a heck of a program, no question about it. So that depending on the eligibility will determine how high the loan can go with no down payment. So and the eligibility and the guarantee for the 25% of the loan, VA guarantees the top 25% of the loan. So usually you'll see the eligibility increase on an annual basis, especially when we see property values moving in an upward direction. But this year, the coming year, 2025, the eligibility is your standard eligibility. So if somebody who had used some of their eligibility before, they could actually go up to 1,209,750 with the down payment. Now, depending on how much eligibility they used would determine how much of a down payment they would need. And then also too, would determine how much of a, not only a down payment, but the sales price would determine, excuse me, the sales price would determine how much that down payment would need to be too. So now in other areas throughout the country, because in what they call the DC MSA metropolitan statistical area, we're considered a high cost, and that's why we have the 1,209,750 loan amounts with partial eligibility. Other areas of the country that are not considered high cost can go up to the 806,500, with partial eligibility. So remember that even if somebody is buying in an area that is not considered a high cost area, if they have full eligibility, then there's no limit on the amount of loan that they can go for. And usually that's going to take care of, especially when you go outside of high cost areas, that's going to take care of most properties that they're going to be looking at as far as sales price is concerned. Now, it doesn't, they're still qualified. It's just that they're allowed to get a higher loan amount with the zero down payment. Or if they have eligibility that's been used, then they can get higher loan amount with a smaller down payment. So the other thing that we see a lot of times that people are not aware of is that a person with VA loan can have multiple loans outstanding at the same time. I've seen as many as two loans outstanding and going for a third loan with the VA. So it all depends on how much eligibility they've used in the past. Now, what happens is, as I stated before, that the eligibility usually increases every year. And because of that, say if you used a certain amount, say 36,800 in the past, as the eligibility increases, that means you'll be able to get a higher loan amount with zero money down or smaller down payments. So all VA loans have to be purchased as a principal residence. So, and the veteran or spouse to occupy within 60 days of settlement. Now, the principal residence, who say, well, if it has to be a principal residence, how can they have two or three loans that have, using the VA? Well, they purchased it as a principal residence, but then once they move into the property, say if they got orders, they transferred to another place, or they got out of the military and then moved to a different area of the country, then they could use their VA again. But again, we will look at the sales price of the new house, the area that they're in, how much eligibility they use, and then that'll give us an idea of how much eligibility is left. And then we can see what they can go with as far as little, no, or no down payment. So some flexibility, example, active service person deployed from a permanent duty station. So the VA is all about helping the veteran out. And you can see retirees that may want to purchase their retirement home. So the VA is looking at each individual situation, and will allow a lot of flexibility. Sometimes it doesn't work. You may not get up to the 12-month maximum, but there certainly will do some flexible situations. And we'll dig into a little bit of the flexibility that they have. But if you have somebody that is looking to use their VA, or they think they might be eligible for the VA, then what you want to do is contact your favorite lender. Hopefully I'm one of those. But we can find out, we can get their information and put it into our lender website with the VA and determine what their eligibility is and how much eligibility they have left, and then can determine what they'll need to do as far as a down payment, if any. So the one thing that I just wanted to throw this slide in there, the VA funding fee. So all VA loans will have a funding fee. And you say, well, what is the funding fee? Well, the funding fee is a fee that the VA collects, and they allow the person using the VA, the borrower, to finance it into the loan amount. So you can see that the first use, if they're putting less than 5% down, it's 2.15%. And then 5% or more, it's 1.5. And then 10% or more, it's 1.25%. So they would take that percentage of the sales price and allow them to finance that into the loan. And then you can see that it's subsequent use. So somebody that's used the VA before and then is going to use it again, it's considerably higher. So less than 5% would be 3.3%, and then 5% or more, 1.5, and then 10% or more, 1.25. So the biggest advantage is when they're putting, or excuse me, the biggest cost is when they're putting less than that 5% down and having a subsequent use. So just remember that if they're using the VA loan, there's usually going to be some type of funding fee. Now, the exception to that, and we're seeing more and more of this exception, is that if the person has a rating with the VA that is 10% or more, a disability rating. And what's happening now is VA didn't used to do this, but when we request the certificate of eligibility, that rating is showing up on the certificate of eligibility. So then we know right away whether they're going to be able to have the funding fee waived or not. But you can see these percentages, especially if you get into the higher loan amounts, it can be a significant amount that they would not have to finance if they have that 10% eligibility. So well, oh gosh, sorry, there you go. So what I wanted to do now is give you an example of somebody that is not in a high cost area and then are using the VA loan, and they've previously used the VA, and they used, in this case, 36,800 of their entitlement. Okay. So what happens is the VA, now the maximum entitlement is the 201 201,625. And you say, well, how did they come up with that number? Well, they took the maximum loan amount for a non-high cost area, which was 608,500, and divided it by 4, because the VA guarantees the top 25%. So we're subtracting the amount of eligibility that was used. So that gives them 164,825. And if you multiply that times 4, that gives them a loan amount of, or excuse me, a sales price of 659,300 that they would be able to use, purchase that property with no money down. Now, if they go above that, the formula for that is the eligibility that they have, and so you multiply that 164,825 times 4. But for every $1,000 they go above that 659, they have to, their down payment's going to be 200 or 25%. So if it's $1,000 above, the down payment's going to be $250. If it's a 10,000, it's 2,500, and if it's 100,000, it's 25,000. So just 25% of the difference. So if you think about it, that last line there, you're saying, okay, 100,000 over the maximum. So 759,300 is the sales price, minus the 25,000 gives them a loan amount of 734,300. That down payment, it's only 3.29% down payment as far as their down payment. And that's with somebody that has used the VA before and going for a sales price of 759,300. So as they would go for a sales price that's less, the down payment would decrease. And if they go for something that's higher, then the down payment would increase. And this is all based on the amount of eligibility that they use. So that's one of the things that we find out right away is if they've used their VA before, has the VA eligibility been reinstated? And you say, well, how would they, if they've used it, how would they get it reinstated? Well, if they used it to purchase a property and they ended up selling that property, there's a process where they can go through, and it's not difficult, but they can go through and get their VA reinstated. They're also able to, like, say, if they purchased a house with the VA and they wanted to use the VA to buy another house, they could actually refinance that house with a conventional loan. And if they were buying another one, then that would be refinancing with a conventional as an investor. And then they could get their VA reinstated and use that a new VA to buy the new house. I've done that before, where a person, they were, buying a new house, and the new house was much more expensive than the older house. So what they did is they reinstated refinanced the old house as an investment property. We were able to get the entitlement, the eligibility reinstated, and then they used the purchase of the new house that they had full eligibility, were able to go with no money down, and then also get a lower interest rate. So it saved them a lot of money and a lot of money out of pocket. They were able to do that. So it can work out really, really well. Now, just remember that there's a lot of, moving parts as far as the loan is concerned. So you just want to make sure that you find out what the eligibility is, if they've used it before or not. Now, what I've run into from time to time is somebody that was in the military, and they didn't realize they had this benefit. They didn't realize that they had a VA benefit. And you're saying, wow, That's amazing. So one of the first questions I would always ask somebody is, do they have VA eligibility? Now, sometimes they don't know it. So then the next question would be, were you ever in the military on that? And there are some cases where people that haven't been in the military that work for some departments for the government that have been granted VA eligibility. So that's always something you want to dig into because it is a very, very attractive program. Now, the next example we're going to look at is we're looking at a high cost area. And we're going to increase the amount. We're looking here to increase the amount of entitlement that's been used, but it's going to be a high cost area. So the high cost, remember, it's the high cost is 1,209,750. And that was on the slide, remember, very at the very beginning on that. So if you're looking for that number. And so the formula, the maximum entitlement, you say, well, how did you come up with that 302,437? We just took the 1,209,750 and divided it by 4 because the VA does the top 25%. Then we subtract the eligibility that the veteran has used before, and that gives them an amount of eligibility that is remaining. So we take that 226,737, multiply it times 4, and then you get a loan amount of 906,948 with no money down. So if you think about it, a high cost area in the DC MSA area goes pretty far south and pretty far west. So this will allow a person to, even if they've used their eligibility before, to be able to get another nice home using the VA and putting no money down. So it's and when we're reviewing these numbers, you're saying, wow, these are a lot of numbers, but for a lender, it would be very easy for us to figure this out based on the information that we can gather from the veteran and also based on the certificate of eligibility that we would get from the VA. So this then is an example for you to show you that with the remaining eligibility that a person has, so they've used that portion of their eligibility, and then again, it's the same 25%. So everything above the loan amount of the, the sales price of 906,948, which is the maximum they can go with zero money down, assuming they use that eligibility, that portion of the eligibility. So for every 1,000 above that, then they would pay, the down payment would be 250. So the down payment is 25% of the difference. So at 10,000 above, the down payment would be 2,500. At 100,000, again, it's going to be 25,000. So if you think about it, even though the person has used a large portion of their eligibility before, and that eligibility that's been used, it depends on when they purchased the house, because remember that eligibility usually goes up every year. So if they bought a property back in, say, the early 2000s and they still had it, then they probably have a lot of eligibility left because it's been increasing every year. And so in this example here, you're taking a sales price of 1,006,948 minus the 25,000 down payment that are required because it's 100,000 over the maximum. And then the loan amount coming out to be $981,948. That down payment is 2.48% of the sales price. So if you're thinking, if you think about it, having $1 million loan and being able to put less than 2.5% down, that's amazing. I mean, they really can't get that type of financing pretty much anywhere. The VA is pretty much the only one that has that type of financing. Excuse me for a minute. Let me take a. I'm getting over a cold, so my throat's a little bit dry on that. So this just shows you that the advantages of the VA is very powerful for the borrower. So if you're working with people and if they have that eligibility, you really want to dig into it because a lot of people, they just say, well, I've used it before. I don't think it's that attractive. It makes a lot of sense to move into it because they may be able to buy a much larger home. And the other good thing about it is VA, like say when you have a conventional loan and you're putting like 3 or 5% down, you have what's called PMI. And even on FHA, you have what's called MIP, and that's part of the monthly payment. On the VA, you don't have any monthly payment like that. And especially if you have somebody has a disability rating, then there's no upfront financing. But even if there was, it's still way cheaper than having the PMI on that size of a loan amount that they charge. Because the PMI is basically insurance that protects the lending institution or the investor on the secondary market in the case of default or foreclosure. What the VA does is they're only guaranteeing the top 25%. So they're giving a lot more flexibility because they want to make it much more attractive for the borrower using the VA home loan on that. So the certificate of eligibility, this is something that we would get. The veteran can get it too online, but it's very easy for us as a lender. There's a lender portal for the VA that we can go in, and based on information that the borrower would provide to us. So basically, it's personal information, their name, the date of birth, some basic information like that, social security number. We would be able to get the certificate of eligibility on that. Now, this certificate of eligibility, the VA has been updating the information that's provided on the certificate of eligibility. It used to be just saying, hey, this is how much eligibility has been used, or this how much eligibility is left. What they're doing now is they're also adding the disability rating. So if they're 10% or more, I could say it's 50%, 75% or 100%. And then two, what we've started to see is they're adding the income that they're receiving because of that disability. So a lot of veterans that are rated as have a disability, you can see that they're getting monthly benefits from that, or a monthly disability pay from the VA, and that can be used for qualifying. So that's starting to show up now on that certificate of eligibility. And then sometimes when we're requesting the eligibility, we are having issues getting it because the VA, believe it or not, sometimes their paperwork is not all together. So we have to dig a little deeper. And so we would get a request for eligibility form. It's 26-1880. And some of the information we would get from the borrower would be statement of service. Now, that is a person that is active duty. We would get that from the commanding officer, or the VA DD 214, a discharge form. So anybody that's been in the military, they know what the DD 214. So it basically is a discharge form. It lists the dates that they've been that they were active in the military, how much time they spent there, and also depending on how many pages, it will also list the accommodations or the awards that they received from the VA on that. So if DD 214, they basically know exactly what that is. The other advantage on the VA loan, now you might be looking with a borrower that is looking to buy a house, and the VA loan is assumable. Now, a buyer, there's two ways it can be assumed. It can be assumed by a person that does not have VA eligibility. And so if the current person that owns the house is selling it and they're allowing that loan to be assumed, and the person that is buying the house does not have VA eligibility, then that person's eligibility, the seller's eligibility, would be tied up into that house. So whatever eligibility they used in order to purchase that house would be tied up into that property until that loan is actually paid off on that. Now, the other way they could get it is the person buying the house has their own VA eligibility. And so what they can do is they can do a substitution of the benefit. In other words, they would replace the eligibility that the seller has on the property with their eligibility. And then that would release the seller and we would be able to get his eligibility reinstated. So then he would have full eligibility. So this is very beneficial in a increased rate markets. So, in the time frame that we saw where we were doing loans like several years ago at 2.5%, 3%, 3.5%, 4%. And then as interest rates moved up, got close to 7%, the assumability becomes very, very attractive. And in a market, down this market, because the inventory is so low, and I'm sure you guys are really seeing that out there, very tight inventory. You're not seeing it as attractive because you have borrowers that are, just going to go in there. So this assumability hasn't been a huge benefit. But now, if you ever get into a situation where interest rates have moved up, and then say the market, there's a lot of inventory out there, where houses, historically, houses will be on the market for what, 30, 60 days, sometimes longer, depending on the market and what's going on. So if you have a house that's on the market and the person selling it has used a VA loan to purchase that house, and they have a low interest rate, say 3%, and the current interest rates are at 7, and there's a lot of properties on the market, then this would be a huge selling advantage for the seller, because they can allow the person buying it, they can offer that they can use or assume that their eligibility, assume that interest rate. So they would take over the interest rate, say if it was 3%, when you have a market that's 7%. That would be very, very attractive. But what we've seen in today's market is that inventory is very, very tight. And a lot of that is because the interest rates have moved up, and a lot of people are not sure what's going to be happening with the economy, with the government. And so they're concerned about that. So not a lot of people are putting their house up on the market. Plus, prices of houses have really dramatically increased. So kind of an unusual situation, but just remember that that assumability can be very attractive, especially as the inventory grows. So the underwriting guidelines for VA are much more flexible than what you're seeing as far as your standard conventional or FHA. FHA is a little bit more flexible, but the VA, I would say, is way more flexible than all the loan programs out there. They're looking basically more of a common sense type of underwriting. So the debt to income and residual income is what they're looking at. Now, the debt to income is they're looking at the current house payment plus their debts, and they're saying that that shouldn't exceed 50%. Now, and then the other one is residual, 50% of their gross income that, or qualifying income that we can use. The residual, so there's two ways they qualify on this. The other one is the residual income consideration. And what they're doing is taking their gross income, and then they have charts where they're subtracting out estimated taxes, estimated utility costs, estimated different costs of home ownership. And then they have a residual, they take out a certain cost for based on the area that they're buying and the number of people in the family. And if that number comes up above what they consider for a particular area, if it's 20% above that, then they will allow that 50% ratio to go considerably higher. I've seen them as high as 56, actually a couple in the 60s, but just because the case was so strong. So you would never get that on other type of qualifying loan programs. So they are very flexible with that, and it makes a lot of sense if the person does have any type of VA eligibility to look at that and see if it would make sense for them. So the flexible ratios, as long as it receives DU approved eligible. Now, DU stands for desktop underwriting. Now, you've heard a lot of talk recently, probably in the last, 6 months, about AI, artificial intelligence. Oh, AI is doing this, AI is doing that. Well, DU is basically, you could consider it AI. We've, in the lending industry, have used it for a long time. And basically, we're putting information into the system, and the desktop underwriting is coming back and saying, yeah, this works, or no, it doesn't work. And if it doesn't work, this is the reason why we don't like it. And so you might want to look at these areas to try and make the case a little stronger. So technically, that is kind of AI, and we've been using it a long time, but it gives us that flexibility. And what it does, it releases or removes some of the responsibility off of the lender if the property does go delinquent or into foreclosure. So that's why most all times you'll see that it has to have a DU approval on that. But there are ways to focus in on why it's not getting that approved eligible, and then try to change the scenario or tweak it in order to get that. But again, just remember the general underwriting guidelines are very flexible as far as the VA is concerned, especially when you're looking at or comparing it to other loan programs out there on that. So the active military income that you're looking at, you got your base pay, your military quarters allowance, what we call BAH, and that will depend on where they're living. Now, a borrower will get BAH if they're not living on base. In other words, say if they're in Quantico, if they're not living on base at Quantico, but they're living in a house, they're renting a house somewhere, then they would get BAH. Now, they would get that, like say if they're living on base, but then they're going to be purchasing the house, then they will be getting BAH. And it can be pretty substantial. And the other thing that's nice about the BAH and also the basic allowance for subsistence is they're both non-taxable. And so what we're allowed to do is gross those up. In other words, estimating the amount that the taxes would be taken off and then adding that to what they're actually getting for qualifying purposes. There's also different types. There's a clothing allowance. There's also like a flight pay, hazard pay, combat pay, medical officers pay. So there's a lot of different pays that the active military can get. And so what we normally get is a copy of their what we call an LES, leave in earnings statement. And then that way we can determine what type of pay they're getting and also determine if it's something that's going to continue. Because that's one of the main things we want to make sure of is that the income that they have is going to be continuing as time goes on. Because if it's not going to continue, like say if they're getting hazard pay, but they're not going to be in their new position or new area that they're going to be in, they're not going to have that hazard pay, then you wouldn't be able to count that. Okay, so the VA, and this is basically talking about the flexibility. So if it makes sense, you can do it. So the VA has no minimum credit score. Now, most lenders will do 600 and above, and we do have some programs that will go below 600. But what happens is now the standard when things were really busy and the market was humming along and there was a lot of inventory, you saw the minimum credit scores were like 620, and then in the really hot markets, you saw the minimum credit scores were like 640 or 660. Well, these have gotten lower because there's not as many loans out there, and so the lenders have gotten more flexible as with the credit scores because the lower the credit scores historically have been very accurate, and what they are is predictors of how a person's going to be making their payments in the future. So the lower the credit scores, more likely that they're going to have some type of issues, a default or disclosure or delinquency on the property. So that's why they restrict it as far as credit scores are concerned. But when there's not a lot of activity or there's not a lot of loans coming through the market, then you'll see that lenders will drop that down. And like I said, right now, you can probably 600 on a credit score, but I've seen them go below that. You can, I think, get 580. Now, the key is that there's going to be some caveats as the credit score goes lower. You're going to get hit with a little bit higher interest rate. The VA is not as dramatic as, like, say, a conventional loan because it's guaranteed by the government. But there's going to be more hoops that they're going to need to jump through to make sure that they qualify for that. And then also, too, they have to get that DU approval on that. So we'll allow alternate credit. And you say, well, what is alternate credit? Well, that's like if they don't have, like, say, credit cards, they don't have car loans, they don't have previous mortgage, but they'll use credit. Alternate credit would be developing a credit with, like, say, a phone bill or utility bills, something along those lines. They'll allow to be used as alternative credit. So, and this is the next one. It says bankruptcy more than 2 years old is okay, and foreclosures more than 2 years old is okay. So that's part of, or some of the most flexible guidelines out there. So you can have somebody that has declared bankruptcy, and then 2 years later, from the date of discharge, they can use the VA loan program again. Same way with a foreclosure. Now, interestingly enough, I had a person that used the VA to purchase a house. It was down in Georgia, and what happened was the house, she was having challenges with it because she had moved up to our area here, and she had to let that house go into foreclosure. And so the eligibility that she had tied up on that property was basically lost to her unless she repaid for that lost eligibility. But moving up to this area, considered a high cost area, and then as time went on, the eligibility increased. And this was probably like 5 or 6 years ago. She was able to buy a townhouse, $480,000 townhouse with no money down, even though she had a previous foreclosure on a VA that had eliminated a certain amount of eligibility that she used to buy that previous property. So it, like I said, very flexible, gives a lot of latitude because they're really trying to help out the active military or the veteran on that. So one of the things that they do here is, and this is kind of the old way that we used to do investment properties, but Fannie Mae and Freddie Mac changed that and it made it much more restrictive. But the VA will still do this. So if you have a person that is looking to buy, but they have a house that they're currently living in, and they're saying that, excuse me for that. That was an Amber Alert. Um, anyway, so if they have a house, so you have somebody that has a house and they want to buy a new house, and but they say, well, I've got this house here and I really don't have a lot of money to put into it, or I have some money, but I can't really qualify because of this house payment. What the VA will do is they'll allow you to take 75% of a lease amount or an anticipated lease amount, 75% of that, and use that to offset the mortgage amount. So that they won't consider like a positive as income, but you can eliminate a lot of the debt. So they may up having keeping that property only having a debt of maybe $200 or $300 a month, maybe a little more, but they'll still be able to use that to qualify for the new house. And then based on the eligibility that they have, and as we said before, eligibility goes up every year when they purchase that house, they may have enough eligibility to buy a new house with no money down or very little money down and buying a much larger house. So it's important to keep that in mind, especially when you're dealing with sellers that are saying, I don't think I can move because, I've got this house and, I don't mind renting it out, but I can't, I can't qualify carrying the rent, carrying the mortgage payment on this house and then carrying a mortgage payment on a new house. So that can be offset and just help them out a lot as far as qualifying on the new property. Now, this is another area where VA is very, very flexible, and it's seller's concessions. So the VA, most of your standard loan programs, like your conventional loan, the person's putting 3% down or 5%. The seller's concessions can't exceed 3% of the sales price. And as they put more money down, like at 10% down, they'll allow it to go to 6%. On the VA, the seller, even if the borrower's putting zero money down, the seller can pay all the usual customary closing costs, including up to 2 discount points. Then the seller can pay an additional 4%, excluding the prepaids, toward whatever is in the vet's best interest or the active military's best interest. This can be points, appliances, it can be purchaser's debt, liens, or judgments. Now, I had a case in this, and you don't see this come out a lot, but it did work out where I had agent called me and said, I've got this seller. They inherited this house. It was in Alexandria, and there's no lien on the property, and they have been in touch with this veteran who they want to try to help get into this property. And so what they were willing to do is they basically paid all the closing costs that they could, plus they paid 2 discount points to get the interest rate down even lower. And then they used that additional 4% to pay off a truck loan that the veteran had. It was like, I think the payment was like $750 a month. He wouldn't qualify with that that truck loan outstanding. So that they used part of that 4% to pay off the truck loan at closing. So we didn't have to count that $750 against the veteran as a debt. So it made him qualify. And then the other thing is, you can see in this picture here, I have a credit card there. But if there's money left over that the seller is willing to pay, say if the seller said, hey, I'll pay this amount, and then you've used it for certain things like paying off debt, doing certain other things, maybe buying appliances, they can end up with, like, say, a Home Depot gift card. Say if there's $2,000 left over, then it would give them a Home Depot gift card for $2,000. So there's no other program out there that will allow that type of flexibility, and it is just something that is, truly amazing for the active military or the veteran on that. It is just, it's just not heard of. So a termite report is required, and it can be paid for by the purchaser or the seller. It used to be the seller had to pay it. And this is one of those things that has changed over time, where it used to be, hey, only the seller has to pay for the termite. Now it can be the seller or the purchaser, depending on how the contract is written on that. So now we want to come into some of the objections that you hear on a VA loan. So if you're working with a VA borrower, and you're putting a contract in, some of the objections that we hear where people, agents are saying, or even could be the seller saying, hey, I don't want to take a VA loan. Well, if you dig into it and say, well, why is that? Well, one of the things we hear is fees. The fees I'm going to get charged, the seller's going to get charged using the VA loan. Now, this has changed a long time ago, but it's still something we see from time to time. So it used to be that the lending institutions used to charge fees. It might be like an underwriting fee or a processing fee or some other type of fee that the VA said the borrower cannot be charged those fees. So what they would do is they would just transfer it over to the seller. But the seller would not become aware of that until they went to closing. So when they got to the closing table, there was these lender fees that might have been like $1,000 or $1,500 that were lender fees charged to the seller on behalf of the buyer. And the seller said, why should I pay for those fees for the borrower? Nobody told me about this. So that has changed, and that changed a number of years ago. So, but you still have people out there that remember that. And so that's no longer the case. Those fees, no lenders that I'm aware of charge any fees to the seller for the type of loan that they're doing, especially a VA loan. Other people will say it takes too long to do the VA process. Well, that again is kind of a misnomer now, because a long time ago, all VA loans had to go down to the VA and they had to underwrite the loan. And so you had, a person who had a lot of underwriters down there, and they would be looking at these stacks every day. And so it was just a number, and they weren't in any hurry to get the loan approved. Now, VA, if you have a lender that has VA automatic, that means that their underwriters are approved to underwrite the VA loans. And so you can get a VA loan done like in less than 30 days. We've done them a lot less than 30 days also. So as far as taking too long, it doesn't really happen anymore. It's not really an excuse. But you still have people that have that, locked into the head. Another one is the appraisers are hard to work with, and then also conditions on an appraisal. So the appraisers, the hard to work with, you used to have appraisers that would just say, hey, you know what? This is the appraisal. That's it. Don't talk to me. Don't call me. I don't want to hear anything about it. That's changed. And because of some recent legislation that the government has, actually it was the Veterans Administration that put it in place. And then conditions on the appraisals. Basically, the conditions that you're going to see on a VA appraisal are mainly what they call safety conditions, and then conditions as far as major systems in there, which you're going to see those type of conditions on a conventional loan also. So what they're looking at is just protecting the borrower, whether it's a conventional loan or a VA loan. Sometimes you'll hear, well, they have to put a railing on a deck, or if there's a doorway on the second floor, a door that opens up and there's nothing below it, they'll make you put like bars across it, or put wood across it so that somebody can't open the door and walk out there. So safety conditions, especially if there's, electrical things, wires hanging and that sort of thing. But you would get those type of conditions on your standard conventional loans. And then appraisal is always coming in low. Now, the next slide, we'll talk about what the Veterans Administration has done to address that particular one, because that was always a big concern. But before we go into that, and other objections that we heard, it's a
Hey, you know
VA
what?
used to,
Terrence says something
oh,
about, I don't understand what LOSY is, but something your volume.
with my volume.
Yeah.
Okay.
Terrence, can you unmute and say what that is? Well, I guess Terrence isn't there.
Okay. Let me check my volume. Are you hearing me okay?
Yeah. Mhm.
Okay. Because I was looking, I
Sometimes
have,
it's their volume. It's their volume on their computer. They've got to click the little speaker thing at the
right.
bottom.
Okay.
And,
Well,
like,
if you can hear me, then we
yeah,
should be okay on that.
right. Okay.
No, it's my speakers. I'm working on them. Okay.
Oh, okay, good. Yeah, because it's at the bottom. Like, I just moved mine down a little bit. So,
Okay.
oh, yeah, okay, great. Thanks.
So Terrence, if there's something you missed after the class, I'm going to send these slides out, but feel free to give me a call. I can review it with you. We can go over it, can help you out. No problem on that. So the other thing I wanted to talk to is the prevailing rate that the VA used to have. So, and what that meant was the government would set a prevailing rate. And so a seller could accept a VA loan on their property they're buying, and then they're saying, okay, I'm paying no points. And then the government would would change the prevailing rate. So say if the prevailing rate was at 7 with 0 points, and the government changed the prevailing rate to 6.5, and now it had 2 points. It used to be that the borrower using the VA could not pay discount points. And so that 2% would go over to the seller. And the sellers were super upset about it, because that could be, like a $500,000 loan. You're talking 2 points, that's $10,000 that they would be losing just because the government changed the prevailing rate. So that is something that is no longer in existence either. The buyer can pay points, there's no issue. The seller doesn't have to take those on. And then as far as the VA appraisal valuation options, there's two options, but one that the VA Veterans Administration came up with is called the Tidewater Initiative. That's pretty common what they is. I'm sure there's some technical name that is much longer, but if you just say the Tidewater Initiative, it's pretty much understood that this is what you're talking about. So what happens is the VA appraiser goes out there. Now, the VA assigns the appraiser. So the lender has no authority to assign a VA appraiser to it. So the person has to be approved by VA. The VA assigns the appraiser. And if the appraiser is doing the appraisal on the property and is having trouble coming up with the value, say, I can't figure out how you guys come up with this value, he's required to contact the lender or anybody that's involved. If he's had contact with the agents, he's required to contact somebody and let them know, hey, I'm having trouble coming up with the value that the contract's written for. Can you send me any information that will help me as far as the value is concerned? Now, it could be, hey, we have Italian marble in the bathrooms, or the kitchen, all the, cabinet work is inlaid with gold or something like that, that they can use to increase the value. Or maybe there's just a comp that they've missed or they're not aware of, or just has recently settled. So they have 48 hours to get that information back to the appraiser, and the appraiser can use that information to increase the value. And we've seen that happen a couple of times. Now, even if the information provided does not give the appraiser the enough information to increase the value to the contract price, he has to address in the appraisal why those things were not acceptable or did not work for him on that. So that's a lot more flexibility than you get on most other appraisals on that. So what the VA has set it up because they want the veteran one to be protected, but they want to make sure that it's just not cut and dry. That the appraiser comes in and says, "Hey, this is it; it's done." It gives everybody involved in the transaction an opportunity to give the appraiser information that could possibly increase the value of the property. And then, say if the appraisal still comes in low, then there's what's called an ROV, reconsideration of value. And this would be something that would be sent to the VA. It would be a request in writing from the veteran or the active service military person, and they would provide supporting data, sold comps mainly, that could be more recent, similar, or more proximity to the property. No more than three total comps on a grid, kind of like a CMA, and then a concise narrative of why they're submitting those comps and why these comps are superior to the ones that were used on the appraisal that they've received back. So what the VA has done is just given the veteran a lot more flexibility to address concerns that they have with the appraisal on that. And then that's the end of the class. Did you all have any questions? Free for all to put them in the chat or to unmute yourself. And also, too, I want to say that if you do have any questions after we get off, or you just, and any type of financing, because I've been doing financing a long time, feel free to use me as a resource. I'd be more than glad to help you out. And also, too, if you have any ideas that you think, hey, this I think would be a good class, feel free to send them to Cindy because, like I said, she's a very super advocate for agents and coming up with ideas and programs that will give them better ideas in order to generate more business. Other than that, I think I'm done. Thank you so much. Very helpful. You're welcome, Linda. And I'm serious. Feel free to reach out to me if I can help you in any way. Same with you, Terrence. Cindy, are you there? I think we might have lost Cindy. Oh, I lost my share.
Jim, are we done? I'm sorry, I'm handling a little emergency over here.
Yeah, we're done.
Okay,
Everybody's done.
thanks. All right,
Johnny
thanks,
just
Beth.
came in though. I don't know who that is.
I know. Yeah. Okay. Well, I have got to go. Bye.
Okay, bye.